Alrighty, so hey everyone, welcome to our webinar regarding the Employee Retention Tax Credit and how you can apply it to your business for both 2020 and 2021. We're very much looking forward to presenting on not only who we are as a company, but also the context of the credit, how we calculate it, and how we can actually work with you on pursuing it as part of your near-term tax strategy. But really, most of all, we are very much excited to have you all and do appreciate you taking the time out of your very busy schedules to learn more about how we can potentially partner with you to help you take advantage of this wonderful opportunity. We are going to have a Q&A session at the end of the webinar, but in the meantime, I do encourage you all to submit any questions that you might have into the chat box as soon as they pop up. And of course, we will definitely address them at the end of the presentation. With that being said, to introduce you to our presenters today, again, my name is Stephen Latch, and I'm part of Layton's business development team based within our office in San Francisco. I've been with Layton for nearly a year and a half and have worked with organizations throughout a variety of different industries to help them pursue government incentives that they're eligible to apply for. My primary focus with Layton is to work with our clients to help them identify relevant credits and learn more about their operational and financial situations to determine if there is a mutual fit for a potential partnership before connecting them with our awesome consultant teams who really essentially do the bulk of the heavy lifting at Layton. Of course, joining me today will be Jen Bolton, who I'll go ahead and pass the mic over to so she can introduce herself.
Thank you, Steve. Welcome, everyone. I'm Jen Bolton. I'm a U.S. senior tax attorney, and I've been working with companies dealing with different tax issues for over 20 years. I've spent a lot of time looking at different government incentives, including today's topic about the Employee Retention Tax Credit, so that we stay current on top of all the new legislative updates and all the ins and outs to help benefit your company.
All righty, let's get the show on the road. So as I'm sure you all know by now, today's presentation, of course, will be focused on the Employee Retention Tax Credit. However, before we do begin covering essentially how the IRS determines qualification for the credit or how it's ultimately going to be calculated, I do want to spend just a quick moment introducing you to Layton and who we are as a company. From there, I'll then provide a very high-level overview of the credit to cover the more basic elements of it before I pass it over to Jen, who will go further into depth on the many elements that the IRS considers when determining whether an organization is going to be eligible for the credit. From there, she'll also cover the different factors that actually go into the calculation of the credit, and how a couple of our customers with somewhat different situations were able to utilize it and how it affected their credits. But finally, I'll go over what our process looks like in actually getting you this credit and what we need to turn this wonderful opportunity into a reality for all of our clients. Oh, and of course, at the end, we will be going into a Q&A to answer any questions that you have about anything that we covered today. But who are we? So Layton is a global consultancy with offices in 12 countries throughout the world, with our headquarters residing in France. And although we were founded in 1997, our US team is relatively young, as Layton expanded into the United States in 2018, with our primary focus of helping companies utilizing the research and development tax credit, which was created to incentivize innovation within the US as an income tax-based opportunity. However, we have grown immensely since 2018. Currently, we have over 100 employees between our offices in both Boston and San Francisco, but we've also expanded our services to provide further value to our client base in the realm of tax incentives. Not only are we still working to discover research and development tax credits, but now we're also helping with reverse sales and use tax audits for clients who say might have overpaid on their sales tax for all of their purchases throughout any given time frame, tax controversy services, and of course, the employee retention credit. However, regardless of the service we're focusing on, we always ensure that we do provide tax and industry experts when needed to make sure that we are working concisely and as accurately as humanly possible with every single one of our clients. But to go a little bit further into the employee retention tax credit, as far as a high level overview goes, it's essentially, it's a relatively new credit, but it's also one that is technically going to be temporary. It was created in March of 2020 as a means of providing aid to organizations throughout the US, and specifically those who might have been struggling because of the pandemic, but by providing a credit that can be applied to their payroll taxes for all the employees that might have been retained within that time frame. With that being said, there have certainly been a few changes since its inception. Initially, there were strict rules around PPP loans, and there was uncertainty around, say, how long the credit could be utilized and which quarters. However, the Consolidated Appropriations Act that went into effect last January changed the rules so that employers could utilize both even after getting a PPP loan. But as of today, we are looking at a credit that is refundable and can be utilized for 2020 and the first 3 quarters of 2021. And the best thing is that you could potentially be looking at a maximum of $33,000 for each employee that you did retain and keep on payroll if you happen to qualify for the credit in its entirety of 2020 and 2021. Of course, the bulk of what our team does is helping all of our clients determine their eligibility, which quarters they're going to be eligible for, how big their credit's going to be, and how they can take or make the necessary amendments to their previous filings so that essentially they could utilize the credit even after the eligible quarters have already passed. So Jen, I'll pass it over to you.
Excellent. Thank you, Steve. So most companies, as you can imagine, suffered because of COVID-19. So the federal government put this incentive in place to try to help companies that were eligible recoup some of the payments that they were making to keep their employees on board and keep paying them. So the first thing that we want to talk about is what is the eligibility criteria for being able to claim the employee retention tax credit. There's 2 ways in which a company can qualify. But first, the most important thing is making sure that the company has employees, that they're paying W-2 employees, and that they're paying them what we'll discuss in a little bit, what are considered qualified wages. So for eligibility criteria, we look at one of 2 ways. We say, did your company have a gross receipts reduction? And we look at that based on a quarter by quarter basis, and we compare it with 2019. Keep in mind, 2019 was pre-COVID, so that is really the measuring stick that the federal government came up with to try to determine gross receipts reduction. For 2021, you would look at your first quarter of 2021, look at your gross receipts. So this is all the income, everything before any types of expenses, and you would compare that with the same quarter, your first quarter of 2019. You would look to see if there's been a reduction of more than 20% in that quarter. If there is, then you are eligible to claim the retention tax credit. For 2020, the rule is a little bit different as far as percentage-wise. It still takes the same quarter for 2020 and compares it with the same quarter of 2019, but instead of using a 20% reduction, it looks at a more than 50% reduction in gross receipts in order to qualify. And if you go down this path, the gross receipts reduction path, for 2020, there's a really special rule. It gets a little complicated. The special rule is once you qualify for a quarter, so say you qualified in the second quarter of 2020, you would continue to qualify in the next quarter until you reach a point in which your gross receipts came back up to 80%. So the reason why they allow this is that the government is saying, we're going to let you continue to be eligible for the credit until you've started to recoup back the lost revenue. Once you hit that 80%, so let's say in the second quarter 2020, you have that more than 50% reduction, you can claim it in the third quarter of 2020, even if you hit 80% or 81%, but you would have to stop and wouldn't be able to take it in the fourth quarter of 2020, unless of course you had a more than 50% reduction again. So it really just gives you an additional stream to continue for 2020. The other way that you can meet eligibility is if you were subject to a government imposed shutdown. So whether that was a partial shutdown or a full shutdown, you could be eligible. And so this is basically, as you guys remember, there was these shelter in place, there was businesses that were considered non-essential, were not able to operate, or they weren't able to operate in the same fashion that they were operating previously. So businesses weren't able to come into their offices, but if they were able to work remotely or they were able to still do their work in a different capacity, the government said you weren't subject to a partial shutdown. There are a whole host of factors that go into determining this partial shutdown. I think it's pretty easy for us to figure out what a full shutdown is, but there are various factors in different scenarios that could make a company potentially eligible for a partial shutdown. Another important factor that we look at when we're determining eligibility is, as Steve had mentioned earlier, did your company take out a PPP loan? If you took out a PPP loan in order to help provide for payroll costs, rent, other types of payments, utilities, it does not exclude you from being eligible for the retention credit. What it does say is that you're not allowed to use the same wages that were used to take out that PPP loan and count them as qualified wages for purposes of determining the employee retention credit. So what they consider is no double dipping. And we have a way in which we are able to analyze your PPP loan, look at the covered and the non-covered period, look at the quarters of which wages were being paid, and be able to feel comfortable that we are not overlapping those payments, that we are specifically excluding payments under the PPP loan from being included within the calculation. Another very important factor is determining the type of employer you're considered for purposes of this credit. As you'll see on the screen, we have large versus small employer. The reason that this is important is because different rules apply for determining which wages you're allowed to claim under the retention credit. If you are a large employer, you are not allowed to claim individuals who were providing services to you within the credit. You would only be allowed to claim individuals in which you were paying them either their wages or healthcare benefits, and they were not providing you services. So you're thinking to yourself, well, what types of employees would that be? It's typically your furloughed employees, which many large companies had to do in order to keep their business afloat in hopes of being able to recover. If you're a small employer, on the other hand, you can claim all the individuals who were both providing services and not providing services, so long as you were making qualified wage payments to them. The definition of a large employer is different for 2020 purposes than it is for 2021. But in any event, the way that you measure large versus small is always going to be based on the number of full-time employees that you had operating in 2019. As you remember, 2019 is our pre-COVID time, so that's the measuring stick. If you had more than 100 full-time employees in 2019, then for purposes of determining the credit calculation for 2020, you'd be considered a large employer and subject to the large employer rules. If you had more than 500 employees, full-time employees in 2019, then for 2021 purposes, you'd be considered a large employer. So you can have, say, if you had 150 full-time employees in 2019, you could be considered a full-time large employer for both for 2020 purposes only, but not for 2021 purposes. So there are a lot of different nuances and intricacies that we pay attention to because of the way that the rules operate. So as I mentioned before, the definition of what's considered qualified employee wages for purposes of calculating the credit is extremely important. Similar to the fact of how certain things qualify for 2020 is different from how things qualify for 2021. For 2020, what we do is we have to look at the qualified wages. What are those qualified wages? Those are really your W-2 payments, the income payments that are made to the individual, and as I'll get to, certain healthcare benefits. You can only include for 2020 up to $10,000 in qualified wages for the entire year. So this isn't something that we look at on a quarter by quarter basis. Once that employee maxes out in 2020, we cannot look at that employee's wages for purposes of the credit for 2020. So if we're allowed to take up to 50% of up to that $10,000 of qualified wages. And the quarters that we look at are quarters 2, 3, and 4 in 2020. And there's a portion of quarter 1, which is March 13th to March 31st of 2020. And that's because this is when the law came into effect, was March 13th of 2020. That's why we're not able to take any qualified wage payments from January 1st to March 12th. So the maximum amount of the credit that you could claim in 2020 per employee is $5,000. For 20, and I know it says full-time employee, but you can also have part-time employees, seasonal help. They do count for the $10,000. The full-time employee is just the measuring test that we use for purposes of determining large or small employees. For 2021, the credit is a little bit better because instead of having the maximum $10,000 of qualified wages on a yearly basis, it's done on a quarterly basis. So you can have 3 potential eligible quarters: quarter 1 of 2021, quarter 2 of 2021, and quarter 3 of 2021. And here you're able to take, instead of 50% of the qualified wage amount up to $10,000, they're giving you a 70% benefit. So in essence, the maximum amount here is really $21,000. I know we said $28,000, but that is because originally the law, through all its various changes, allowed a maximum amount of $28,000 because the fourth quarter of 2021 was includable, and that was when the employee retention tax credit was going to terminate. However, as many of you, if you are watching the current news, the House and the Senate had voted on that infrastructure bill, which the president is expected to sign this week, and they are terminating eligibility of the credit to end on September 30th of 2021 retroactively, so that quarter 4 of 2021 is not eligible except in limited circumstances for certain businesses, which are considered recovery startup businesses. What are the healthcare benefits that can be included? As I mentioned before, it is really the pre-tax contributions from either the employee or employer. You can use both of them to help include that $10,000 of qualified wages. You can also include FSAs and certain HRAs within the qualified wage amount. As we mentioned earlier, the PPP loan, it does not automatically exclude you from eligibility. You're still able to include, or still be rather to claim the employee retention credit. You just have to ensure that you're not double dipping and including those same wages that were used in the PPP loan for purposes of claiming the employee retention tax credit. And as I mentioned before, we are very careful about ensuring that we do not have that overlap when we prepare the calculation. So the quarter eligibility in 2020, the gross receipts for any quarter in 2020, except starting March 13th of 2020 to the end of March 31st of 2020, plus all of quarters 2, 3, and 4. We look and we compare that to the same quarters in 2019 just to see if there is a more than 50% decline in gross receipts. And for 2021, the gross receipts for any quarter, or there's a special rule in 2021, just like there was a special rule in 2020. 2021 says that you can also elect an alternate quarter method, meaning that you can look at the preceding quarter of 2021 and see if you are eligible based on that 20% rule. So for example, if we were looking at 2021 quarter 1, we did not meet that 20% reduction, the more than 20% reduction in 2021, we could actually look at the preceding quarter, which is 2020's quarter 4, and look at the gross receipts there and see if we were able to meet the more than 20% reduction for eligibility. And if we do, we can claim 2021 quarter 1 based on that preceding quarter of eligibility. Now for 21, if we were looking at the second quarter, and we've determined that we can't use that alternate method because we didn't qualify on our own merit for quarter 1 of 2021. As you remember, we looked at the preceding quarter of quarter 4 of 2020. In order to qualify for the second quarter of 2021, it would have to, on its own merits, be able to be eligible of the comparison between second quarter 2021, second quarter 2019, and have that significant decline in gross receipts of more than 20%. A lot of information that we're throwing at you, and it gets very complicated, but rest assured that we are very familiar with these rules and all the intricacies, and we continue to stay on top of legislative changes. As I mentioned, the new legislation that'll be signed, that'll be coming into effect anytime soon, as the president will be signing that bill. I just wanted to share with you just a couple of the clients that we've seen, because I think it helps put into perspective the types of different employers that we have worked on. For example, we had a nonprofit client that had just over 100 employees. So remember, if we were looking at 2020, this client would be considered a large employer. But when we did our analysis, the company only qualified for the first 2 quarters of 2021. And as a result of qualifying for just 2021, they're able to claim an over $1 million credit for their employees. They would have been able to have claimed even more, if you think about it, if there's 100 employees in each quarter, if they were eligible for all of 2021, it's $7,000 maximum per employee per quarter. So it would have been for quarters 1, 2, and 3. But in this case, they only qualified for the first 2 quarters of 2021. They actually had a very small PPP loan relative to all the wages that they were paying. And we were very careful to make sure that we excluded the PPP loan amounts from the amounts that we were including as qualified wages. The basis for eligibility for this client was that they had a significant decrease in gross receipts for the first 2 quarters of 2021 compared to the first 2 quarters of 2019. We've also had other clients that were in the private education industry, and they had less than 500 employees, and they were eligible for over a $500,000 credit. We were able to look at not only their qualified wages, because some of their wage amounts didn't hit that $10,000 of maximum eligibility, but when we were able to include their healthcare benefits, we were able to get an increase in the amount of the credit that they qualified for, because as I mentioned earlier, healthcare benefits are included within the qualified wage base. So they were able to utilize the credit for 2020 and in different quarters within 2021. So different types of clients see different types of benefits, but it's really astonishing to realize that companies that were paying their employees to try to keep their businesses afloat are able to utilize this credit.
And to go further into the process that we have of actually getting you the credit is, well, first off, I mean, we do our very best to make sure that we do take up as little of our clients' time as possible. And the first step is simply to have a quick conversation with a member of our business development team, mostly just to ensure that there is a potential credit available before we start collecting all of the relevant documentation. Typically, it's at this point where we're able to come up with a rough ballpark estimate as to what we think that you're going to be eligible for, and both parties think that it makes sense to move forward into an introduction with our tax attorneys. And once we do collect these documents, we have the initial assessment to clear up any questions we might have about your financial situation. But honestly, most of the communication after that is going to be done over email, just to clear up any of the one-off questions that come up throughout any of our work. I would also like to highlight that, if we do, for whatever reason, determine that maybe there is no credit after the initial assessment, maybe we missed something that maybe makes it to where you're not eligible. I mean, there are 0 fees required by our clients at that point. we really do want to make sure and ensure that this is a low risk engagement and will never require payment for services that aren't resulting in us delivering our final report, which outlines why you're eligible, how much you're going to be eligible for, and of course, how we got to the calculations that we ultimately did. Once we do provide all of the documents, you need to begin preparing the necessary amendments. It's just a matter of working with whoever files your tax returns to make sure that they are utilizing our work to reflect in your previous filings. That's more or less it. I think we did a good job of covering a very high level overview of the credit today. Figured we'd go ahead and open it up for any questions that any of the attendees might have regarding our presentation and anything we might have touched on. Okay, so the first question that we have is, what if your customer is subject to a shutdown? So not necessarily the business in question that we are communicating with had to shut down, but what if one of their customers had to shut down?
That's a great question, Steve. And unfortunately, customers who are subject to government shutdowns or are unable to attend events or be able to participate in a company's business does not qualify as a partial shutdown for purposes of the retention credit. But what's interesting, though, is if your supplier, on the other hand, was subject to a government shutdown where you were not able to get the raw materials that you needed for your business, and there were no other suppliers out there that you could get this raw material from, that in fact does qualify you as a partial shutdown. So just because customers are not able to be included in a partial shutdown definition, your lack of being able to connect with your suppliers to get the materials you need do qualify.
Awesome.
Great question.
Well, next question, does working from home count as a shutdown?
That's a really interesting question as well, because it depends on your business operation. It depends on how you're able to continue to carry on your business. They look at measuring, or the government looks at measuring what it was like for you pre-COVID to transitioning from working from home. So for example, Layton, as a business, we were very much in office type of business where everybody came into the office, we all worked. However, once COVID hit, we went and we were able to work from home smoothly. We were able to still carry on our business operations. And so we would not be able to qualify. It's really just evaluating the company's different situation and seeing between pre-COVID and COVID, how a company is able to carry on their business operations.
Okay, awesome. And at this point, it's the last question that we have, unless any others come up, but can nonprofits utilize this credit?
Absolutely. So this is a great area, and we have actually worked with a lot of nonprofits. And the way that it works, because you see and you think to yourself, well, they don't really have gross receipts, so they're not really taxable, is the only way that they could qualify through a government shutdown. And the answer is no, they can qualify through that gross receipts reduction scenario. What happens is, even though they don't pay taxable income, you determine gross receipts based on contributions, membership fees, and all donations, and all other information that would be considered their income, even though it's not taxable. And you would do that comparison with whatever quarter you're looking at and look at the same quarter in 2019. And because this is an employment payroll benefit, they do pay their employees W-2 wages, and that's how they're eligible to get the credit, because it's a payroll employment tax credit as opposed to an income tax credit. I want to mention, because I don't believe we mentioned this, but what's really important is that whatever employee retention tax credit a company claims, they need to go back and take an adjustment to their income tax return for the amount of the credit. So for example, if a company took a 2020 credit of $100,000 of the employee retention tax credit, they would need to go back and amend their 2020 income tax return to account for that $100,000 employee retention credit. In other words, the wages that they paid individuals are typically taken as a deduction on their income tax return. They would need to add back that $100,000. So just the reason being is that the government doesn't want you to double dip and take a benefit of claiming an employee retention tax credit for employment tax purposes and also taking an income tax deduction on those same wages for income tax purposes.
Okay, and so that's it for the questions. I guess I'll give it a couple seconds. If anybody has any last minute questions for us to answer, we'll gladly do so before hopping off. Going once, going twice. All righty, well, if there aren't any more questions, I guess we'll start to wrap up. But thanks again to everybody for joining. We really do appreciate you spending your time learning more about Layton and the employee retention credit. Again, this is a great opportunity for you to utilize a great essential opportunity to lower your tax payments during a time of hardship and uncertainty. And we would love to partner with you to help you get there. But that's a wrap. Please contact us if you have any questions or would like to set up a conversation with a member of our business development team, and we will gladly help coordinate a time for us to chat. Take care, everybody.
Thank you.